You set it up on day one. Your manager or HR person or the online portal told you to pick a contribution rate and choose a fund. You picked 6% because that felt responsible. You scrolled the list of fund options for approximately 4 minutes. You picked the one with the year closest to the year you plan to retire. It had a name like Target Date 2060 Fund. You clicked Confirm. You closed the tab. That was 3 years ago, or 7, or 11. You have not touched it since. You have been vaguely aware that the number goes up, that it dips when the market dips and recovers when the market recovers, that it is there, running, doing something you do not fully understand. You have told yourself you will learn more about it when you have time. You have not had time. Here is what is actually happening inside the account you set up and never touched. And here is what it is costing you to not know, what a target date fund actually is. The Target Date 2060 Fund, or 2055 or 2065, whatever year you chose, is a fund of funds. It owns other funds. Inside it, right now, is a mixture of stock index funds, bond index funds, and sometimes real estate or international funds. The ratio of stocks to bonds shifts automatically as the target year approaches. Right now, if you are young, it is probably 90% stocks and 10% bonds. By the time the target year arrives, it will have shifted to something closer to 40% stocks and 60% bonds, more conservative, less volatile, appropriate for someone who is about to start spending the money rather than accumulating it. This is called the glide path. It is automated. You did not have to think about it. That was the design. The target date fund is not a bad choice. For most people, most of the time, it is a reasonable default. The problem is not what it is investing in. The problem is what it costs to invest there. Expense ratios. Every fund charges a fee for managing your money. The fee is expressed as a percentage of your assets annually. It is called the expense ratio. It is deducted automatically. You never see it leave your account. It is simply subtracted from the return before the return is reported to you. The average expense ratio of a target date fund at a major provider is between 0.10 and 0.75%. That range matters more than it sounds. Here's the math. You have $40,000 in your 401k. You will contribute for 30 more years. You add $400 a month. The market averages 7% annually. With an expense ratio of 0.10%, the low end, you retire with approximately $682,000. With an expense ratio of 0.75%, the high end, you retire with approximately $598,000. The difference is $84,000, paid not to you but to the fund manager, for doing what the lower cost fund also does. This is the first thing to check. Log in to your 401k portal. Find the fund you are in. Find the expense ratio. If it is above 0.20%, there is almost certainly a lower cost option in the same plan. What the employer match actually is, and whether you are leaving it on the table. Your employer match is the most important number in your entire compensation package, and it receives less attention than your dental plan. Here's why it matters. If your employer matches 50% of your contributions up to 6% of your salary, and you contribute 6%, you receive 3% of your salary as free additional compensation deposited directly into your retirement account. Free, no taxes owed, no work required, just the act of contributing at the right level. If you contribute 4% instead of 6, you receive 2% match instead of 3. You have left 1% of your salary in free compensation uncollected. At $70,000 a year, that is $700 a year. Invested for 30 years at 7%, that uncollected $700 annually becomes approximately $66,000. You left $66,000 on the table by contributing 4% instead of 6. Most people do not know their match formula. They picked a contribution rate on day one and did not revisit it. The contribution rate they picked was often not the rate that captures the full match. Sometimes it was, sometimes it was not. Very few people checked. Log in. Find the match formula. Find your current contribution rate. If you are not capturing the full match, Change the contribution rate. This is the single highest return action available to you in personal finance. The return is 50 to 100% guaranteed on the first day. No investment in the world offers that. What the Roth option inside your 401k is and whether you should be using it. Many 401k plans now offer a Roth option. This is different from contributing to a traditional 401k. The difference is when you pay taxes. Traditional 401k, you contribute pre-tax dollars. The contribution reduces your taxable income today. You pay taxes when you withdraw in retirement. Roth 401k, you contribute post-tax dollars. The contribution does not reduce your taxable income today. You pay no taxes on the growth or the withdrawal in retirement, which is better depends on one thing: whether your tax rate is higher now or in retirement. If you expect to be in a higher tax bracket in retirement, which is possible if your investments grow significantly, the Roth is better. You pay taxes now at the lower rate and collect the growth tax-free. If you expect to be in a lower bracket in retirement, the traditional is better. For most people in their 20s and early 30s who are currently in the 22% federal bracket, the Roth option is worth serious consideration. You are paying taxes at 22% now on money that will compound for 30 to 40 years and come out tax-free. The longer the compounding period, the more valuable the tax-free withdrawal. This is worth investigating, not a certainty. An investigation: your situation, your current income, your expected retirement income, your state taxes, your other accounts, determines the answer. But most people have never considered the question because the Roth option inside the 401k is not the default. They chose the default. The default is not always wrong, but it is always worth examining once. The second rule: defaults in financial systems are not designed for your benefit. They are designed for the average. You are not the average. Check the defaults, one by one. What vesting means and why you might be leaving your employer's money behind when you leave. Vesting is the schedule on which your employer's matching contributions become legally yours. The match is deposited into your account immediately. Whether it belongs to you depends on how long you have stayed. Many companies use a graded vesting schedule: 20% vesting per year, reaching 100% at 5 years. Some use cliff vesting: nothing until year 3, then 100% all at once. Some are immediately vested from day 1. If you leave at 2.5 years at a company with a 3-year cliff vest, you leave with none of the employer's contributions. The money goes back to the company. The contributions you made are yours. Their match, not yet. This is a real consideration when you are evaluating whether and when to leave a job. The vesting cliff or schedule is a golden handcuff. It is designed to be one. Knowing the schedule tells you the financial cost of leaving before a specific date. Run this number before you accept or decline a job offer and before you give notice. Call HR. Ask for the vesting schedule. Calculate what unvested employer contributions you would forfeit. Include that number in your decision. Most people do not know their vesting schedule. They know their salary. They sometimes know their match formula. The vesting schedule, which can represent tens of thousands of dollars, is rarely examined until the day someone gives notice and is told they are leaving most of it behind. What happens to your 401k when you change jobs? You have 4 options when you leave an employer with a 401k balance. Option 1. Leave it with the old employer. This is allowed if the balance is above a threshold, usually $5,000. The account continues to grow. You are now managing 2 separate accounts. The old account may have limited investment options and potentially higher fees than alternatives. Not the worst choice, not the best. Option 2. Roll it into your new employer's 401k. This consolidates your accounts. The quality of the new plan's investment options determines whether this is better or worse than rolling to an IRA. Some employer plans have excellent low-cost index funds. Others have expensive options. Check before rolling. Option 3. Roll it into an IRA. This is usually the most flexible option. An IRA, individual retirement account, can be opened at any brokerage and provides access to the full range of investment options, including the lowest cost index funds available anywhere. No employer involvement. You control it directly. Option 4. Cash it out. Do not do this. If you are under 59 and a half, you will owe income tax on the full amount plus a 10% early withdrawal penalty. On a $30,000 account, you receive approximately $19,500 after taxes and penalty. You have permanently removed $30,000 of compound growth from your retirement and paid $10,500 for the privilege. The first three options keep the money growing. The fourth does not. People cash out 401ks when they change jobs more often than the financial industry acknowledges. The short-term cash feels significant. The long-term cost does not. The correct default when you change jobs. Roll to IRA, unless the new employer plan is demonstrably better. Decide within 60 days. After 60 days, the rollover process becomes more complicated. The third rule, the 401k you set up and never touched is working for you. The 401k you set up wrong and never touched is working against you slowly. The difference is 3 hours and the willingness to read the statements. Here is the 3-hour audit of your 401k. Hour 1. Find out where you are. Log into your 401k portal. The login information is in your benefits email from when you were hired, or HR can resend it. Write down your current balance, your contribution rate, percentage of salary going in, your employer's match formula, the fund or funds you are invested in, the expense ratio of each fund, your current vesting percentage, and the schedule. That is hour 1. You now know where you are. Hour 2. Find out where you should be. Is your contribution rate capturing the full employer match? If not, change it today. This takes 5 minutes. Is your expense ratio above 0.20%? If yes, find the lowest cost index fund available in your plan. Usually this is a total market index fund or S&P 500 index fund. Look for the one with the lowest expense ratio. It is often labeled institutional or index. It often has fewer words in its name. Switch your contributions to go there and consider moving your existing balance there. Is there a Roth option in your plan? If yes, spend 20 minutes understanding whether it applies to your situation. A fee-only financial advisor can tell you in one meeting. It is worth knowing. Do you know your vesting schedule? If not, find it. Call HR if you cannot find it in the portal. That is hour 2. Hour 3. Project where you are going. Use any free retirement calculator. Vanguard, Fidelity, and NerdWallet all have them. Enter your current balance, your contribution rate, your employer match, an expected return of 7%, and the number of years until you plan to retire. Look at the number. Does it match what you have in mind for retirement? If it does, your current path is sufficient. If it does not, you now know the size of the gap. You know what additional contribution, or additional time, or additional return is required to close it. The gap is information. Information allows decisions. Ignoring the gap does not make it smaller. It just means you discover it later when it is harder to address. 3 hours. That is the audit. Most people have not done it in the entire time they have had the account. What a fee-only financial advisor actually is and when to pay one. A fee-only financial advisor charges you directly for their time and advice. They do not earn commissions on the products they recommend. They have no financial incentive to recommend anything other than what is right for your situation. This is different from a financial advisor at a bank or insurance company who is paid by commission. Those advisors may give good advice. They may also have a financial incentive to recommend the product that pays them the highest commission. You cannot easily tell which is happening. A fee-only advisor charges between $150 and $400 per hour for a one-time consultation, or between $1,000 and $3,000 for a comprehensive financial plan. That fee, for most people, is returned many times over through tax optimization, fee reduction, and contribution strategy. NAPFA, the National Association of Personal Financial Advisors, has a directory of fee-only advisors. One 2-hour meeting with a fee-only advisor to review your 401k, your tax situation, and your overall savings structure will give you more actionable information than 10 years of meaning to look into it. You do not need to hand over your money. You need one meeting to get the full picture. Then you can act on it yourself. The fourth rule: compound interest works in both directions. It builds wealth when the conditions are right. It builds fees, taxes, and gaps when the conditions are suboptimal. The difference between optimal and suboptimal in a 401k is not dramatic action. It is 3 hours and one meeting. You set it up on day one and you did the right thing. You captured at least some of the match. You picked a fund. You left it alone. Leaving it alone is part of the strategy. Do not touch it during market downturns. Do not check it daily. Do not move it based on headlines. But leaving it alone is not the same as never examining it. The 3-hour audit is not a disruption of the strategy. It is the completion of it. You set it up. Now verify that what you set up is correctly calibrated. It probably mostly is. There are probably one or two things to adjust. Those adjustments, made now, compound for the rest of your career. The account is running. It has been running since day one. The question is whether it is running at the right settings. Log in. Find the number, run the audit. 3 hours, one meeting. That is the difference between the account you set up and the account that actually works for you.